Stop what you're doing right now. Seriously, if you own bank stocks, you need to hear this fundamental breakdown. What if I told you that the bank, which was once the ultimate poster child for regulatory nightmares, is now quietly executing one of the most massive turnarounds in modern financial history? I know, it sounds crazy. It's a totally contrarian thought. Many retail investors still carry a deep fear of legacy banking stocks, totally scarred by those scandalous headlines of the past. But running the stock's Q1 26 data through our valuation models completely shifted our perspective. If Warren Buffett or Peter Lynch were running their classic checklist on this quarter's numbers, they would be paying very close attention. Welcome to this explainer. Today we're diving deep into the monumental regulatory milestones and the incredibly robust Q1 26 financial results of Wells Fargo. By the end of this explainer, you'll know exactly why Wall Street is looking at this financial giant with a completely renewed set of eyes and whether it's a value trap or a genuine buy.
Let's start with a really surprising number. Just look at this, 14. That is the exact number of regulatory consent orders Wells Fargo has successfully closed since 2019. For years, the market viewed these orders as a massive anchor just dragging down the stock. But the closure of that final outstanding order last month, it's a huge turning point. It's the official closing of a very dark chapter and the dawn of a highly efficient, strictly managed new era for the bank.
Okay, here's our roadmap for today's explainer. We're going to start with free from the Fed, unpack the Q1 2026 earnings highlights, see how fee income is leading growth, look at how they're rewarding shareholders, and wrap it all up with what the analysts say. All right, part 1, free from the Fed, the end of the 2018 asset cap. To really grasp Wells Fargo's current trajectory, we have to look at the massive historical milestone that just freed up their balance sheet. For years, they've literally been operating with one hand tied behind their back. But look at this definitive language right from the Federal Reserve itself. The Fed explicitly confirmed that Wells Fargo's massive risk management and governance overhaul actually satisfied the conditions for removal. You see, since 2018, this asset growth restriction essentially capped the size of their balance sheet. It stopped them from growing their loan and deposit base past a certain threshold, meaning they just couldn't compete fully with rivals like JP Morgan or Bank of America. So this quote right here, it's the ultimate green light. The ceiling has officially been shattered. Anchored by this renewed trust in the closure of that final consent order, the official Q1 2026 earnings release sets the stage for a much leaner, completely unrestricted operation. CEO Charlie Scharf even noted they're now operating with significant excess capital. So you're probably wondering, how does a bank actually perform in its first quarter stepping out of the regulatory shadows? Well, let's get into it in part 2. Q1 2026 earnings highlights, unpacking the hard numbers. Moving right into the actual financial breakdown, we can see exactly how they performed under this new era. Let's look at the metrics here. We've got total revenue coming in at $21.4 billion. That's a really solid 6% increase year over year. Net income is up 7% to $5.3 billion. But here is the absolutely crucial point. Look at that 15% jump in earnings per share, going from $1.39 to $1.60. Why is EPS growing so much faster than top-line revenue? It tells us that top-line growth is being super efficiently translated into bottom-line profitability. They aren't just making more money, they're actually keeping way more of it per share. And this perfectly illustrates their relentless efficiency strategy. You've got total revenue climbing 6%, while simultaneously they've slashed their headcount by 7%. And what really stands out is that this marks 23 consecutive quarters of headcount reductions. That is nearly 6 straight years of systematically trimming the workforce and streamlining their operations. It creates what we call positive operating leverage, basically doing a lot more business with much lower overhead costs. Now, to be completely objective here, we have to talk about the headwinds. It wasn't a flawless quarter across the board. We did see a sequential dip in net interest income, or NII, which retreated 2% from the fourth quarter of 2025. This was mostly because of higher deposit costs, meaning the bank had to pay out more interest to keep customers' cash, combined with pressure from lower interest rates on floating rate assets. But importantly, management kept their full-year guidance anchored right at roughly $50 billion. That signals they believe this dip is just a temporary bump, not some sort of structural breakdown. Which brings us to part 3. Fee income leads growth, offsetting NII volatility. To combat that dip in net interest income, Wells Fargo leaned heavily into its high-margin fee-generating businesses to really carry the quarter. This is the hallmark of a truly resilient financial institution. When one engine sputters a bit, the others roar to life to make up the difference. Breaking this down across the segments, you can literally see how diversified their revenue stream has become. Consumer banking is still the massive core at $10 billion, sure, but look at corporate and investment banking bringing in $5.3 billion and wealth and investment management right on its heels at $3.9 billion. Non-interest income, which is mostly fee-based, soared 8% year over year. The markets business specifically was a huge driver here, with revenue up 19% thanks to higher customer activity across the board.
Now, that wealth and investment management segment was an absolute powerhouse for the quarter. Total revenue shot up 14% year over year. But more importantly, client assets grew 11% to a staggering $2.2 trillion. They hit their highest net asset flows in over 10 years. Plus, this is their third consecutive quarter of strong advisor hiring. What you really need to take away from this is simple. Wells Fargo is successfully repairing its reputation. High net worth clients and top-tier advisors are clearly trusting the brand again.
Meanwhile, the consumer engine is showing incredible momentum, highlighted by this crazy 60% year-over-year explosion in new credit card account openings. Thanks to 2 brand new card launches in the first quarter, they added over 631,000 new accounts. At the same time, their mobile active customers grew to 33.5 million. This kind of digital and product momentum is directly fueling higher purchase volumes and card fees. Moving on to part 4. Rewarding the shareholders, executing the capital return strategy. With efficiency high, revenue diversified, and that asset cap officially gone, the immediate question is, how is the bank returning all this generated value back to you, the investor?
Well, in just the first quarter of 2026 alone, Wells Fargo executed a massive $4 billion in common stock repurchases, retiring 46.3 million shares. This is exactly why we saw that 15% jump in earnings per share earlier. By shrinking the total number of slices in the pie, every remaining slice just becomes so much more valuable. Overall, period-end common shares outstanding are down 6% from a year ago.
This timeline really charts out their sustainable payout approach. It started accelerating last summer when they passed the June 2025 Fed stress tests with flying colors. Their required capital buffer dropped to the bare minimum of 2.5%. That gave them the green light to raise their common stock dividend by 12.5% in July. Now, after buying back $4 billion in Q1, they still have a staggering $29.7 billion in remaining buyback capacity. Plus, with a liquidity coverage ratio of 120%, which is well above the regulatory minimum, their balance sheet is basically a fortress right now.
All right, let's wrap things up with part 5. What the analysts say. Wall Street's forward outlook. Let's look at how the broader market is actually pricing in this turnaround and analyzing the stock's future trajectory. Institutional sentiment often trails fundamental improvements, but the narrative is clearly starting to shift here. Spanning from a low of $59 all the way to a high of $108, this consensus reflects a sort of cautious optimism. With 27 analysts weighing in, the consensus target sits right around $88.98. The broad range shows that while some analysts are still sweating macroeconomic uncertainties, like sticky inflation or higher energy prices, the bulls at the top end, like Barclays with their $108 target, believe the combined power of share buybacks, freed up asset growth, and relentless expense discipline is going to continue to drive massive shareholder value.
As we wrap up this explainer, the most fascinating takeaway to consider is how management is going to deploy this hard-won freedom. The shackles are completely off. They have the capital, they have the regulatory green light, and they have the momentum in both wealth management and consumer lending. The question is no longer whether Wells Fargo can survive its past, but rather, how fast and how aggressively will they reclaim their dominant market position to shape the future of banking? Thanks so much for learning with us today, and we'll see you in the next explainer.